Welcome to the Deep Dive, brought to you by Talk Tickers. We're your guide for getting straight to the heart of earnings calls.
Helping you understand what really matters.
Today, we're digging into UMB Financial Corporation, that's UMBF. Specifically, their Q2 2025 results and the earnings call that followed.
And it was quite a quarter, wasn't it? A lot going on.
Definitely felt like more than just numbers. Strategic moves, some big financial beats, and the market certainly seemed to notice.
Oh, absolutely. The reaction was positive, and importantly, it seems to have stuck. It wasn't just a one-day pop. We saw what you'd call a clean beat on the key metrics.
Clean beat, I like that.
Yeah, and the trading volume that day was heavy, lots of interest. The stocks kept that positive momentum since then, which, signals real confidence.
Okay, so let's get into those headline numbers. What really stood out from the Q2 results?
Well, the big one was operating EPS, that's earnings per share. Non-GAAP came in at $2.96.
$2.96. Wow. What were estimates?
Consensus was around $2.35. So yeah, they beat that by 26%. Pretty substantial.
26% is huge. And revenue.
Revenue was also impressive, $689.2 million. That beat estimates by about 8.4%. But the really striking number is the year-over-year growth.
Okay.
Up 76.7%. A massive jump.
76% year over year. Okay. A lot of that has to be the acquisition, right?
Yeah.
But still impressive. What about the core banking metrics? Efficiency.
Right. Good question. Net interest margin, or NM, expanded. It hit 3.10%, which is up 14 basis points just from the prior quarter. That's a healthy move.
So their core profitability is getting stronger.
Exactly. And the efficiency ratio, how much they spend to make a dollar, that improved quite a bit too, down to 53.4% from 63.4% a year ago. So a 10-point drop. That's significant cost control, or I guess revenue leverage.
Yeah, that's making each dollar work harder.
Yeah.
And the balance sheet fundamentals, loans, deposits.
Both grew nicely quarter over quarter. Average loans were up 12.7% and average deposits climbed 10.7%. So, healthy growth across the board.
Okay, really solid numbers all around. Let's unpack the why. The big elephant in the room, or maybe the new engine in the room, is the Heartland Financial acquisition, HTLF. They closed that deal end of January, so Q2 was the first full quarter impact.
Exactly. And it was clearly a major driver. Management pointed directly to HTLF for fueling that double-digit loan and deposit growth we just talked about.
How's the integration itself going? That's always the tricky part.
Seems to be going well, maybe even a bit ahead of plan in some ways. They had a successful pilot conversion in mid-July.
Pilot conversion?
Yeah, they moved HTLF's Minnesota branches onto UMBF's main system, kind of like a test run.
The dress rehearsal. Makes sense.
Precisely. And that sets them up for the main event, the full conversion of all the other HTLF markets.
Which is targeted for when?
Mid-October 2025. So coming up pretty soon.
And why is that mid-October date so key?
It's crucial for unlocking the next big chunk of cost savings. Plus, it helps normalize something called purchase accounting accretion.
Right, the accounting noise from the deal.
Exactly. Getting that sorted makes the underlying performance much clearer. They've already booked $17 million in quarterly cost savings from HTLF.
So $17 million already banked. What's the total target?
They're aiming for $124 million in total annual savings, and management sounded confident they'll get there. They said the next big slug of savings should hit in Q4 this year and Q1 next year.
Okay, cost savings are progressing. But acquisitions aren't just about cutting costs. Are they seeing revenue benefits yet? Synergies.
They are, though it sounds like early days still. Management mentioned new mortgage products rolling out in the former HTLF areas. Strong credit card activity there, too.
Good signs.
Yeah, and they're seeing possibilities for corporate trust referrals. The phrasing they used was interesting, just beginning to see what can come out of the HTLF team. Suggests quite a bit of untapped potential, cross-selling growth in those new footprints.
Okay, so HTLF is a huge piece. Let's zoom out a bit to the overall financials again. Net interest margin, NIM. We said it expanded overall, but what about the core margin, stripping out those deal effects?
Good point. The core margin in Q2 was 2.83%.
And the outlook for Q3?
They guided for Q3 core margin to be essentially flat.
Flat. Okay. Why flat after seeing expansion? What are the moving parts there?
It's kind of a push and pull. On the plus side, they expect fixed rate assets like bonds and loans to reprice higher as older ones mature.
Okay, that helps.
But that's likely getting offset by higher interest expense. Why? Because they're seeing strong growth in interest-bearing deposits, which cost more. Plus, Q3 is typically a low point for non-interest-bearing deposits, the cheap funding.
So deposit mix and seasonality playing a role.
Right. And here's a key nuance. Management was clear that deposit pricing itself, the rates they offer, should stay stable unless the Fed cuts rates.
So a Fed cut could actually help the
Could
market.
do, yeah. Because some deposits are indexed, they'd reprice lower pretty quickly if the Fed cuts. That would be a tailwind.
Interesting dynamic.
Yeah.
Okay, let's shift gears to non-interest income. That looked really strong in Q2. What drove that?
A big piece, definitely, was about $37.7 million in pre-tax gains from private investments.
Private investments, like venture capital.
Sort of, yeah. They have a portfolio. The standout was a $29.4 million gain from the Voyager Technologies IPO back in June.
Okay, that's a significant one-time item. But what about the recurring fee businesses? Are those growing too?
They are, and that's arguably more important for the long term. Fund services income was up $3.5 million. They're winning new clients, and assets under administration are growing.
How much are they managing now?
Topped $600 billion for institutional banking. It's a huge number.
Wow.
And bank card fees were also up, over 10%, driven by higher spending volumes. So beyond the one-off games, the core fee engine is performing really well.
So this diversification into fees, especially fund services in that private market space, it seems like a core part of their strategy now.
Absolutely. It provides a strong, less volatile income stream compared to just relying on lending margins. They seem really well positioned there, especially with all the activity in private markets needing administration. It's becoming a defining characteristic for them.
Makes sense. Okay, what about the expense side of the equation? They guided Q3 operating expenses a bit higher, right?
Yeah.
$380 to $385 million range.
Yeah, slightly higher, mostly due to pretty standard stuff, mid-year salary increases, higher incentive payouts because the company is doing well, and just, an extra day in the quarter. Nothing too alarming there.
And the tax rate outlook.
For the full year 2025, they expect the effective tax rate to land somewhere between 19% and 21%.
Got it. And while we're on the balance sheet side, any notable capital actions? Strengthening the foundation.
Yes, a couple of things. They did a Series B preferred stock offering in June. That brought in about $294 million in Tier 1 capital.
Bolstering their capital cushion.
Right. And then in July, they redeemed some older Series A preferred stock, about $115 million worth that they actually acquired as part of the HTLF deal. So actively managing their capital structure.
Okay. And the all-important credit quality. How are the loans performing?
Really solid. This is a traditional strength for UMBF, and it showed net charge-offs, NCOs, were just 17 basis points overall. Legacy UMB was even better at 13 basis points.
It's very low.
Extremely low. And non-performing loans, NPLs, actually improved down to 26 basis points. Compare that to the peer median, which is around 50 basis points.
So significantly better than peers.
Much better. Management expects NCOs to stay low, near or below historical averages for the rest of the year. And importantly, the NPLs they inherited from HTLF are already trending down as they align that portfolio with UMBF standards.
That's reassuring on the integration front, too. Okay, so great numbers, integration on track, solid credit.
Yeah.
When the analysts got their chance to ask questions on the call, what were they focusing on? What were Mariner Kier, the CEO, and Ron Scher, the CFO, highlighting?
Well, Kier set a positive tone about the business environment. Scher gave the detailed guidance. Analysts, naturally, dug into a few key areas. Loan growth was one.
Understandable, given the big jump.
Yeah, an analyst from RBC asked about the $1.9 billion in new loan production. Management said it was strong across C&I, CRA lending, and especially residential mortgages in those new HTLF states. They called it in line with expectations and expect similar strength going forward.
Any other hot topics?
Health savings accounts, HSAs came up. There were some recent legislative changes.
Right, potentially expanding eligibility. Jim Ryan, the president, addressed that.
He did. He acknowledged the changes could bring maybe 7 million more people into eligibility, but framed it as a marginal opportunity.
Not a huge windfall.
Apparently not. More something that needs education and effort rather than an automatic boom for their HSA business.
Okay. What about expenses long term? Beyond just Q3 guidance, an analyst from Barclays asked about that.
Yeah, they wanted to know the run rate after the HTLF savings are fully baked in. Management stressed they're focused on positive operating leverage.
Meaning revenue growing faster than expenses.
Exactly. And they reiterated their commitment to getting all those HTLF cost savings. They also mentioned not having a big backlog of unapproved spending plans, suggesting continued discipline.
And deposit costs, always a focus. Any pressure there?
It came up. Interestingly, while the cost of interest-bearing deposits was flat, the overall average cost ticked up slightly.
How does that work?
It was a mixed shift. They saw strong growth in middle market and institutional deposits, which tend to carry higher rates than, say, consumer checking. So it wasn't existing customers demanding higher rates, but rather the composition of the new deposits coming in.
Oh, okay. That makes sense. And it ties into leveraging the new HTLF network, right? Getting more consumer deposits over time.
Precisely. Management talked about using that expanded branch network 6 new states with marketing campaigns and refreshes to attract more of those sticky, lower-cost consumer deposits. It's part of building a more granular, stable funding base long-term.
Okay, so pulling it all together, strong results, integration moving forward, solid outlook. What's the bigger picture for investors looking at UMBF now? How's the sentiment?
Well, as we said up front, sentiment is definitely bullish tilted. The clean beats, the efficiency gains, the NIM expansion, it all resonated.
And the stock price reflected that.
It sure did. Leading up to early September, the stock was up over 12% in just a month. And since the end of Q2, it's up over 15%.
How does that compare to the market?
Significantly better. The S&P 500, the SPY tracker, was only up about 3% over that same one-month period, so clear outperformance.
Okay, strong run. But what are the key things investors should be watching now? What are the potential catalysts or risks?
Number one is definitely the HTLF integration execution, especially that mid-October full conversion. Eyes are on that.
Making sure it goes smoothly.
Exactly. Also, while those private investment gains were great for Q2, investors know they're lumpy. So the focus remains on the growth of recurring fee income and core banking profitability.
And the NIM outlook.
That's a big watch item. Management's flat core NIM guidance, assuming no Fed cuts, maybe tempered some expectations. If the Fed does cut, that becomes a potential upside catalyst. If not, the focus stays on managing deposit costs and loan yields effectively.
So it sounds like UMBF is really evolving its story.
I think that's the key takeaway. They're consciously morphing, as the analysts put it, from being just a quality regional bank into something bigger, a more diversified financial institution with significant scale added by HTLF.
Aiming for higher returns and less volatility.
That's the goal. Mid-teens return on tangible common equity, or ROTCE, and smoother earnings through different economic cycles. The catalysts are clear. The October conversion, delivering on expense control in Q3, and how that core margin performs relative to Fed actions.
All right, it's time for our Not Financial Advice segment. Quick reminder to everyone listening, this is purely for informational and entertainment purposes. Always do your own research and consult with a professional.
Absolutely. So my outrageous but plausible idea for UMBF isn't just about the next quarter, it's longer term. I'm thinking about long-term out-of-the-money call options. Maybe strikes around $140, $150, expiring late 2026.
Okay, that's definitely reaching. What's the rationale?
It's a bet that the market is underestimating the combined power of two things. First, the second wave of HTLF synergies. Remember management saying they're just beginning to see what can come out?
Right, the revenue side.
Exactly. I think the full potential for fee growth and loan production from that bigger network, once it's fully humming, could significantly beat current expectations. More operating leverage than just the cost saves.
Okay, that's one factor. What's the second?
The second is what I'd call the hidden gem multiplier. That Voyager IPO gain wasn't just luck. It showed their private investment team has real skill. They have a portfolio of over 50 companies.
So you're betting on another big win.
It's a low probability bet, sure, but if another one of those investments has a significant liquidity event by late 2026, and you combine that potential kicker with the successful HTLF integration story, well, that's a powerful combo that standard bank valuations might miss. It adds an innovation premium to the solid integration narrative.
Interesting. Layering potential upside on top of the core execution story. Definitely food for thought. So wrap things up. UMB Financial Corp, UMBF, put up a really strong Q2 2025. Significant progress integrating Heartland Financial, and their diversified fee businesses are showing real strength.
Yeah, and while executing the rest of the integration and navigating the NIM path are key watch items, their disciplined approach and clear strategic shift seem to have them well positioned.
And for you listening, maybe the question to ponder is, how effectively can UMBF leverage this new scale and diversification? What does this transformation mean for them in the competitive banking landscape over the next few years? That was The Deep Dive, brought to you by Tonk Tickers. Remember, this discussion is for informational purposes only. It's not investment advice. Send us your thoughts and questions for future dives. Thanks for tuning in.